Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
Hello, thank you for joining us. It is once again a tri-merge of stockcheatsheets.substack.com, our audience with Chake and Power users, and our podcast audience that's listening to the Macro Monkeys podcast. I'm Double A retail trader based in Denver, Colorado. Once again, joined by my decade-long trading partner, Mike O'Connor, who is in Austin, Texas.
Yep, and whenever I have a winning day, I'm a professional trader. And whenever I get my ass kicked, I'm a rank amateur who will sell at the bottom, right? Rank amateur who sells at the bottom, buys at the top.
I call myself retail because it encapsulates both of those things.
So we're going to get through a lot today, but I think we need to. We're going to start with the macroeconomic, and then we'll move into the Chake and analytics. We always like to do a little bit of a software demo as we talk about the market, because that's the one platform that allows us to look at a combination of technicals and fundamentals. And then finally, for cheat sheet subscribers, some added value on some of the cheat sheet signals and some of the stocks that I found that might be worth trading if this potential FOMO rally we get to continue on Monday starts. So that is the big question. Double A, maybe you could explain to me how the Fed can basically be to the right of the Supreme Court. I mean, I think they would have a sperm arrested if this were an abortion clinic. In terms of the amount of harshness, how dead set on inflicting pain they were until Thursday afternoon, Friday morning, ahead of the Japanese stock market open, where suddenly, we might slow the pace of tightening a little bit in December. Calm down, everyone. Stop selling bonds.
Yeah, you know, Mike, it's hilarious. I was pointing out to you, and I just pulled it up here. On Thursday, late in the day Thursday, a Fed official was quoted as saying ongoing rate increases are likely needed. And then Friday morning, another Fed official is quoted as saying it's important that we slow our rate hikes. Yes. How anybody can take any of this seriously anymore, I just don't know.
And then there was a speech at UCal Berkeley by the afternoon that was talking about how we have to get ready for the onboarding of an easier policy or something to that effect. Not exactly the right words, but.
Well, I mean, there's a number. I mean, they're obviously trying to engineer the outcome they want through verbal diarrhea, I guess. Right. I don't know what to call it, but I think something that it maybe caught their attention this week was what appears to be a breakout in 10-year yield, closing for the week above 4%, just over 4% at 4.2, which that 3.94%-ish level has been just ultra important going back for 2 decades. And now we're on the other side of it, the side we haven't seen since about 2003. So I wonder if that is what caught their eye and, precipitated their, wishy-washy back and forth comments.
And for those who are familiar with TD Ameritrade's market forecast oscillator, I'm not going to get into it, but the bonds readings on that oscillator were such that on Thursday afternoon, I actually sent about an hour before the close a note to cheat sheet subscribers because I had never seen so many global index oscillators, the 2 key ones that would basically forecast the last time I saw it like that was during the financial crisis, like in the Lehman era. I saw 2 pinned well below sort of their breakdown threshold. And I thought, oh my God, we're going to have a lookout below day tomorrow. And it was all driven by the bond meltdown. And I'm showing on the screen for those of you who are watching the video, just the relentless march downward on the TLT. What's ironic is the long end of the curve wasn't really affected by the gum jobs that much. Bonds, continue to go down. Friday morning, it was, I guess, late in the day that they reversed a little bit. And we finished sort of with a doji, at least in the long end of the curve. And then I'm not sure about the front end of the curve. I think it did a little better.
Yeah, I'm looking at a weekly just on my end here. I'm looking at a weekly on the 10-year, which is why I monitor most closely. Yeah. And it's a pretty bullish weekly candle.
Yep. And the SHY, which is the ETF that tracks the 1 to 3 year treasuries, was also it finished up pretty almost a 1.5 percentage wise, which is a big move for this kind of stock. So my thought is follow through seems likely unless the Fed believes that the market mistook their leak to the Wall Street Journal too exuberantly, which is always possible, right? We have several Fed governor speeches Tuesday through Thursday next week. It's Fed-a-palooza. There's about 4 of them.
There's also, I want to come back to bonds real quick, but I'll just tack onto that. So in addition to, more Fed gum jobs, incredibly important earnings week coming up.
Incredibly important earnings week and a whole slew of earnings announcements. That's one thing, or not earnings announcements. I'm sorry. What do you call economic data coming out?
Yeah. So real quick, just to maybe put a bow tie in the bonds conversation. We talked real briefly before we started, and it definitely was a meltdown. I don't think the sell-off in bonds this week got the attention it deserved. I think it's a pretty serious development. And,
I certainly thought that.
And I'm curious, since going back to, or not even going back, but mentioning dollar strength, right? We've talked about that for weeks now. I had an idea that perhaps it was some foreign government who's a large holder of U.S. Treasuries selling Treasuries in an effort to raise dollars, who could then sell those dollars to buy their own currency to defend it against the U.S. dollar. I mean, I don't know that.
Well, they don't make the announcement. Bank of Japan, I think, is what you're referring to, right? Or the rumored entity.
Yeah, a Bank of Japan, or one of many other countries whose currency is just getting killed by the dollar.
Well, the Bank of Japan, it's pretty clear they stepped in and bought yen on Friday, their Friday afternoon, I guess. It would be our Thursday overnight.
Which would make sense, because if they were selling bonds Thursday, they'd have the cash on Friday. Right? Yeah.
Yep.
So anyway.
Well, and the dollar reversed pretty hard. The UUP is actually kind of stuck. That's the ETF that tracks the dollar. I guess I could look at the dollar index on my trading screen. It's depending upon what instrument you're looking at, it's we basically have hit our head. We've actually put in kind of a similar high and maybe a lower high on an oscillator. Mm-hmm. So the dollar, I think feels more like consolidation than a reversal. But I guess that's okay. And the relative strength in multiple time frames is still pretty good. And the money flow, I can't do that on a dollar index, but the money flow on the UUP, actually, I'm just trying to see here. It's actually weakening. It's down near negative, close to negative 0.2, which would make it pretty seriously under distribution. So the dollar kind of hit a peak money flow wise back in the late September, and this month has been a little softer for the dollar, but it's probably just consolidation.
Right. And related, the euro, I think, is maybe trying to find a bottom, so that those two things would line up if in fact that's the case.
Yeah, and the euros looks exactly opposite from the dollar, and more money flow. They're buying euros, and that's because the Europe was sort of behind the Fed, but they're starting to catch up now. And I think even the Bank of England, although boy, what a week for those guys. I mean, between the U.S. and Britain, we are definitely in a beauty pageant for most fucked up democracy in the world.
Yeah, it's becoming quite the contest to find out who's worse.
Yeah, well, I think it's Britain, because they don't have an economy to speak of. They don't have any trade deals with anyone. Do they even have a trade deal with us? I don't think they do.
I don't know. I mean, that was the whole idea of Brexit, right? They'll do it on their own, and they really haven't.
Ready, fire, aim, Brexit.
Yeah.
Yep. Well, UK is always ahead of America, whether it's COVID cases or, some kind of fashion trend. So I would expect that whatever
nationalism.
Yes, exactly right.
Yeah.
So I guess whatever autocratic right-wing movement, I guess we're starting in Italy this time, but it'll happen to the UK and then probably head our way. So
yeah.
Who knows? It's going to be a crazy, and we didn't even talk about that. The other reason I think the stocks could have reversed is, does Janet Yellen have the ability to kind of write an overnight check to buy some stocks out of the Treasury and then sell them back the next day? Because it sure feels like every time the market is about to break down, there's a move. Have you noticed that?
I have noticed it, and we've talked about it. I'm pretty active on Twitter. I've tweeted about it a little bit. It definitely gets. I definitely have the feeling that there's some intervention, some meddling going on somewhere.
Look at this.
Yeah.
what we're looking at now is the first time the stock market broke the what do you call it, the 3,600 area, for lack of a better word. That's been a stubborn kind of low area. We broke it and we closed below it, and everybody lined up to go short. And then the short squeeze was on. It only lasted 2 days. Yeah. And then again, we cratered. And this time we finished even lower. Shorts were placed on then this massive bullish engulfing pattern, which is basically a bullish reversal pattern on stocks. And this time, when it looked like the bond market was collapsing, I actually uncovered some puts because I thought, yes, finally, going to get the whoosh. And sure enough, I went into the weekend. I should have recovered them on Friday, but
it's interesting because that new low, which then resulted in the same day, resulted in that bullish engulfing pattern. That was the day we found out that CPI was higher than anybody expected the prior month, which also to me makes sense that there's somebody putting their fingers in there to keep it from collapsing.
Yep.
So
ironically, we're sort of backed into a head and shoulders bottom reversal pattern, and I could see us basically running through the holidays and closing back up at around 4,100 in diagonal resistance as we look at charts. Sorry for those of you who listen to the podcast, but I think you can visualize this, that we've been in a kind of a pattern of not only lower highs and lower lows in the stock market, but this widening pattern where the lows get lower and the highs get a little wider, so that we form this thing called a bugle or a megaphone pattern, which is a bearish pattern. But it's probably about time, every few months we trade back up to diagonal resistance. So I've got that probably by the time we get there, 4,100 maybe, something like that.
Well, I don't disagree with the assessment or your numbers, but I push back just a little bit on the timing. I don't know that we're quite ready yet. I think there's too much unknown ahead of us in the next couple of weeks that perhaps, and again, none of us know, right? None of us know. But to me, it makes more sense that the next couple of weeks remain choppy as we deal with elections and there's some events coming up in the next couple of weeks in a Fed meeting also. And then once we get past those things and volatility subsides, then maybe we can ramp up into the end of the year.
Yep. You're probably right. There's probably nothing is going to be explosive, but I think we're probably due for a little follow through on Monday. I could be wrong, but it felt the way we closed with that oscillator that we look at in the market forecast, just pinning above 95 across lots of sectors and all of kind of the commodity, all the inflationary sectors, which are if the Fed is going to wimp out, this is what would rally. Kind of that was the move. It was XLI, defense sector, XLI, XLB, metals and mining. I mean, we can go through them when it gets time to look at the charts, but it was all commodity based, basic materials, energy, defense, the kind of stuff that would be a little bit inflationary.
You know what I found interesting on Friday is obviously the markets rallied pretty hard, the indices did. But what I found interesting on Friday was that given the quote unquote Fed leak, volatility stayed bid. It was nearly green at a couple different points in the day, and it ended down ever so slightly. But in years past, months past, weeks past, maybe even on a leak like that, on an interpretation of that kind of news by the market, I would have thought that volatility would have came in a lot more. What do you think?
Yeah, bigger candle, and we've seen that before. But vol, I think, kind of just crept down throughout the week. So while we didn't get it in one big move, we did get from about 35 down to about 28, 29. So in effect, it was a 20% down move in volatility. It was just more orderly.
Got it. That's a really good point. I just would have expected a little more reaction on the headline on Friday.
Sure. And it looks like what we did get, the biggest reaction was on Thursday. So in other words, the non-public information traders out there, meaning members of our government, settled all their positions up for Friday trading before the rest of us knew about it.
And that's the game we play.
Yes, it is. It's definitely. And, I don't even pretend when I write my cheat sheet blogs, I just educate younger traders and say, here's how the market moves. And I'll talk about supply and demand and how, estimates matter, the Fed matters, economic environment matters. But really what matters most is what insiders know and how much they trade it.
That's right. So looking to the week ahead, we mentioned earlier, big earnings week. Apple, I
Huge,
believe, is
about
this
a
week.
third of the
Yeah.
S&P. I think it's 165 stocks.
And it's those companies that are heavily weighted too. So I mean, they're going to move the market.
It is.
Based on what you saw last week from earnings. I mean, Tesla was a little disappointing. They're pretty big. I think the banks did pretty well. Do you have a sense or a feeling yet of what to expect from earnings, or what you expect?
Well, listen, I went a little under the hood on the earnings that we just got back, and kind of on the headline is we did pretty well, right? The story we got from most of the reports is at in line or beat, right? And we didn't get as much gloom and doom. Most of the people connected to the consumer said that the consumer isn't dead yet. They're still spending, right? There was all of that. There were, other than the folks involved with the banks, who I think are more concerned about what the Fed is going to do to liquidity and the counterparty risk and potentially credit contagion. They're more sensitized to that in the financial service industry. But those companies connected to the consumer, I think, were pretty mellow. So my sense is that the media portrayed earnings as better than they were. But if you actually look underneath the hood, there are some, I don't know how to describe it, some VH1 behind the music, sort of behind the headlines. Mm-hmm. So, for example, 20% of the companies in the S&P 500 reported so far, and the earnings have been decent. 72% reported actual earnings per share above estimates, but that's below the 5-year average of 77%. It's below the 10-year average of 73%, meaning it is normal for 3/4 of the company to beat estimates, but the trend line is lower. So it's a real subtle sort of thing. And there's other metrics like that. So basically, companies reporting earnings that were averaged about 2.3% above estimate. So that was the average beat, but that's below the 5-year average, and not by a little, by a lot. It's the 5-year average is almost 9% is what the typical beat is. So we were less than a third of that. And the 10-year beat, we were less than half of that at 6.5% versus 2.33%. So it's that kind of quiet little, sort of like relative strength. When we look at relative strength, it's a creeper. But it actually matters a little bit how relative strength does. I would say the relative position of earnings against same earnings this time a year ago, 5 years ago, 10 years ago on a percentage basis, that does matter. And we're seeing maybe a topping of the corporate earnings pattern. That's
really interesting because that's obviously going to creep into the PE of the S&P 500 itself, right? Which is still above the historical norm. I think it's, it's 18 or 19 when historically it's 15 or 16. So
we're priced better than the earnings trajectory.
Right. So there has to be recalibration, or there should be.
There is, and we're going to get a ton of data next week. Obviously, I think the big shiny object is going to be Q3 GDP, which, by the way, I think it's the consensus is about 2.5 points on GDP after 2 negative quarters. So if inflation hicked anything up, there might be a downside surprise on GDP. But you've got lots of housing metrics next week. Case-Shiller is next week. There's housing starts. There's another home price index besides Case-Shiller. We have durable goods. We've got the University of Michigan, the kind of you missed consumer sentiment. There's several versions of that throughout the month. I think this might be the final October, so it's not going to be that market moving. But we have also core PCE. We've got pending home sales. We've got a consumer spending study, tons of data, tons of earnings, and at least 4 Fed speeches next week.
It has all the makings of a very whippy week. Would you agree with that?
I do, especially when you consider the report includes about more than a third of Dow companies next week.
Yeah.
So the mega caps are going.
You mentioned housing. Maybe we'll wrap up the Macro Monkeys portion of this with this. I just realized this week. So there's a mortgage-backed security ETF. It is MBB, I believe.
Yeah, I tracked it on 2 feeds.
Yeah. Did you realize? And it just smacked me. It is currently 11% below its lowest point back in 2008.
I'm looking at it right here. It's in a horrible downtrend, this ETF.
So there's less appetite right now for mortgage-backed securities than in 2008 when the crisis was about mortgage-backed securities. I don't know why, but that just startled me.
Well, again, the entire debt complex sort of cascaded lower. And of course, anybody who's been counting on the bond portion of their portfolio to save them from this horrible year has been—
forget about it.
Yeah, it's been magnified. And there's a whole bunch of people retiring now with less net worth than they started with by a lot. So I think that is going to be another headwind for the market. When you think about it, two things happen. Whenever there are hard times roll around and there's a sustained bear market, it usually takes about 5 years for mom and pop retail investors to get back in the game. They get shaken out at the very bottom. I don't think we're there yet, right? I think we've still got the shakeout to come.
I agree.
And so you'll have that, and then retail traders reluctant to get back in. They'll get back in once we've made it 75% of the way back up before the next bear market.
Right.
We have, but the other difference is we're starting to hit the peak retirement years in terms of demographics, right? The people hitting 65 the next year and the year after, it's basically we're done with the baby boomers at that point, right? Another 3 years, I think it is. I'm 58 and considered, I guess, the last year of baby boom. So I guess technically we have 7 years ago, though I think my generation feels more like Gen X than baby boom. But we're starting to run out of the biggest generation, and they're cashing out of equities. So there's not going to be the same run rate into 401ks, the blind investments that we've had for decades in the past. We're going to start shrinking in terms of our total retail investment pool.
That's interesting. But that's also another reason, not to jump around too much, but those are the people and the reason why that maybe the end of the year brings that rally, right? Just to bring the numbers back up a little bit for end of year numbers and satisfy all those holding the 401ks, make it a little less painful when they look at your year-end statements.
Yeah, again, to the extent the government manipulates for that. But I think we're due for a little bit of a rally here. I just don't know how big it's going to be, but It felt like Friday's price action was a little bit of it broke some water, and there's nothing we can do. The baby's coming, that kind of thing. Again, it could be a 3-day rally. It could be a half-a-day rally, or it could be a 4-week rally. I just don't know.
Yeah. I guess we will find out this week. And like you said, we'll have a lot of information provided this week, and we'll discuss it next week.
And so we're going to move, we're going to segue into the Chaikin Analytics portion of the program. So it's basically a macro discussion with some prettier pictures. Chaikin Analytics is a software package that AA and I have represented for going on 11, 12 years now. And Mark Chaikin and his son built this thing, and basically using 20 factors that Mark, throughout his career as a counselor to trading desks. That's what he built terminals and came up with technical indicators. You're familiar with Chaikin Money Flow, for example. He's got a couple other ones. And so that was Mark's history in Wall Street. His wife, he retired in the middle part of the early 2000s. And that's when the financial crisis happens. His wife, Sandy, got wiped out to the tune of 50% of her 401k, gonzo. She actually did pretty well, considering. And so he came out of retirement, built this model targeting retail investors or fiduciary money managers. Now, of course, since then, the Chaikin Analytics platform is basically as ubiquitous at Wall Street firms as the Bloomberg terminal is. In fact, I think it's baked into the Bloomberg terminal now. So the Chaikin platform has grown up, and recently Stansberry Research bought them. You'll know of Stansberry if you've ever watched a video that always starts with "move your money now."
Yeah.
You have no idea what's coming. You know those guys? That's them. And they've got all sorts of products they sell. And Mark has come out with a new "Move Your Money Now," which he just spliced into an old video, which I thought was kind of lazy. But so he updated his prediction, taking credit for the last one, which was actually a recycled video from the time before. But what he lacks in marketing savvy, He makes up for with a great app. And the difference between the app that I'm sharing with you and Cheat Sheets is that Cheat Sheets will give you great technicals, and Cheat Sheets is cheap, $5 a month, $50 a year to get a ton of data for you to make trading decisions. And that was my goal in creating Cheat Sheets as the architect of that one, was to take data that a lot of people use, but organized once and for all in sort of a proprietary way that constitutes a system for those who don't have big enough investment accounts to be able to access Chaikin. But if you do, and I mean you've got 100, 200,000 or more to trade, then you owe it to yourself for what is going to be between $1,500 and $2,500 a year access to Chaikin Analytics. As a percentage of assets under management, it becomes a good deal when you're in the hundreds of thousands of dollars worth of investment capital to run. And you get a very sophisticated tool set, all the kind of technicals that you care about. But what really is the secret sauce for Chaikin is the power gauge. And so AA, that's my big windup. You and I spend much more time with the ETF portion of Chaikin, especially during earnings season. But the stock engine is very powerful and allows you to do some very sophisticated things like short stuff that you probably never heard of before, just because you get a combination of technical and fundamental readouts that say this company is a piece of crap, it's going lower, and you've had a great run for years shorting stocks using Chaikin.
You know what else? It's absolutely right. But you know what else it really helps with? Saving time, because it lets you do all those things very quickly and let you find, potential opportunity with just a few clicks. That's what I like about it.
So let's go through our process here. We always like to start by leveraging the strength, which is Chaikin's financial evaluation of 3,000 companies every day, if not more now, but the Russell 3000 for sure, and several ETFs. Now, we always start with the SPY, and we like to look at a few things. One is the bull-bear ratio. And that double, I noticed, is definitely not portending any kind of rally anytime soon. It took a while for the fundamental scores to dry up on Chaikin. Remember, as the market was panicking lower in February, we noted that we'd seen this not too often in the past. Normally, the market collapse would happen first, but the fundamentals would usually catch up. That really didn't happen. Even months into the downturn, we still saw good fundamental scores, the combination of things like cash flow and analysts bringing up estimates and price to sales ratios and the other kind of Warren Buffett metrics that are kind of the key to the Chaikin fundamental system. They've held up pretty well this year. We've never really gotten down, as far as I know, you look at this more often than I do, we've never gotten down into that 0.10, 0.05 level. Have we during this bear market? Have we gotten that fractional low yet? Did we get down there before the big summer rally?
So we had a very recently we were at 0.09, and that was the first week of October.
Wow. So we've come a long way back up.
And prior to that, the middle of June, we were at 0.08. So those are the two times since the beginning of the year that we've had those low readings. Was
very interesting that you picked that up. And, yep. And we have not, and that might be another reason why we didn't break the support level. We kept trying. But we didn't. I remember as I was generating watch lists as part of my research, where I use a variety of different inputs for cheat sheets to kind of come up with a fundamental work list. I use Chaikin. I use the Fidelity aggregate score. There's one that TD Ameritrade has. There's a bunch of research reports that are available. There's Tasty Trades, technical reports. I use all of those things to kind of come up with a work list for our subscribers. But I noticed that as I was running the Chaikin screeners, that the number of stocks that started meeting pretty bullish criteria started going up over the last 2 weeks, which was another thing that I just happened to notice, another data point that suggested, maybe we're going to have a small rally here, or a good earnings season anyway, based on the number of power bars. But as I look at this, it's not horrible, but 69, 170, 26, that's what, about 0.6, 0.7, something like that?
0.55.
Okay, close.
Yeah.
0.55.
Mm-hmm.
We have price below, I think, both moving averages. No, actually, price has managed to get up above the 21-day moving average. That's this dotted line in the middle of the two volatility bands. It's just barely above it, but it is up there. We kind of flagged up. We got a bit of an inverse pennant here. We are below a downtrending long-term moving average. We have money flow that's negative. We have relative strength versus the IWV, the broad Russell 3000 that's underwater, and we're overbought, trying to break out of a double bottom pattern here. The money flow is just not there, though, is it?
No, it doesn't appear to be.
No.
The oscillator has
going to be a FOMO rally. It's going to be starting from scratch because we did not get. Now, money flow is a 21-day indicator, and so the Fed just whispered on Thursday afternoon. So it's going to take a little while for money flow to change.
Yeah, the oscillator has a little momentum to it, though.
It does, and we've seen the divergence. I picked that up in my own RSI, where I noticed similar lows and higher lows in momentum oscillators. I've noticed that for the last couple of weeks.
Yeah,
we certainly have that here, right? We've got basically lower highs and lower lows in price, and in effect, we have a higher high. We have two higher highs and two higher lows in price on Chaikin.
So a little bit of a bullish sign there. I mean,
yeah. Yep. I think that for me, neutral strategies, I think, are probably a pretty good bet right now.
I agree.
Yeah. Then we like to look at, so basically our conclusion would be we don't have that many bullish factors. We've got a negative fundamental factor. We are down and below a downtrending long-term average. That's now 3 negative factors. The 21-day moving average is downtrending. That's 4. We are above the 21-day. That's 1. So we are basically market. Would we call that market down or market down positive potential? I can't remember.
I thought it was market neutral positive potential because we have greater than 0.5 on the fundamentals, right? It's coded as yellow on our sheet here, and we have 1 green. So, but I could be wrong on the call.
Yeah. So it's been a while since we've done this, but basically we're suggesting the markets go both ways. Now on cheat sheets, which we'll get to in a minute, there are 4 time frames that drive. It's kind of similar to Chaikin. They've got just imagine a Chaikin oscillator that had 4 discrete time frames. Well, the Chaikin oscillators, long-term and intermediate time frames, don't agree with each other. The intermediate time frames on the cheat sheets just turned bullish on Friday. So they're in disagreement. Whenever that happens, you could say the market could bleed up, but is frustratingly not likely to trend in one direction without changing course. So we're going to be choppy, I think, is what we're saying from the indicators we see.
Yep. I agree with that.
So as we look at the My Stocks list, this is sort of our listing in aggregate of everything that we would, I think, that would stand for an important aspect of the global economy. And we're seeing kind of the same thing. A lot of bearish equity and bond ETFs, bunch of stuff that doesn't have a power gauge, which we can look at. And then very few things that are bullish. ILF, which is Latin America, is a very 40 stocks. And there are 3 stocks that are a third of that ETF. To make a long story short, basic materials and energy drive Latin America, with maybe financials in there as well. And energy is doing really well, and materials are doing really well.
Have you noticed Brazil lately?
Yeah, and EWZ rallies whenever there's a presidential election. You remember that when Bolsonaro got nominated and then won in the runoff, Brazil rallied. I remember that. I'm actually naked long EWZ.
Okay. Well, then you have noticed it. Yeah. It had a pretty bullish week.
Yeah, it did. It recovered. Mm-hmm. IWT is another metric we like to look at. Neutral rating, the power gauge ratio, which is the fundamentals, is really negative. It's 2 to 14, bulls to bears. Again, we're crawling along the bottom. It looks just like the market, overbought, with no relative strength, no good fundamentals, and no money flow, and horrible trends. Transports and semis are the 2 I think we'd call market bellwethers. And I don't think we're seeing semis looks even worse. And China's going to try to take our semis away.
I think we've tried to take them away from ourselves with all our rules on them.
Now I'm seeing more divergences in the oscillators, AA. You see the cascading downward spiral in price and a series of higher lows on the oscillator.
Yep. No, that's starting to become a common thread here, isn't it?
A little bit of a theme. Yep. Now, emerging markets is driven by, will be driven bearishly by high interest rates. Emerging markets especially don't like that. But we also have emerging markets as resource based. And once again, same thing, similar lows to / lower lows, and oscillators making a higher low in price.
Yep.
Treasuries look horrible. And there was no respite for the long end of the curve on Thursday. Nobody wants to buy long bonds, not when interest rates are going up parabolically.
Yeah, the Treasury market is just ugly.
Yep. The only one that might be working a little bit, although it's got a bearish rating too, and it might not be doing that well. Of course, it is. The yield is tied to inflation, but certainly not the underlying price of the security. And so we're going sideways on tips. But I think that's a bit of an inflation tell too, that we're not going up. There's no demand for tips, despite the fact that if you have a 60-40 portfolio, listen, you can go down just like any other bond, but at least your yield will be tethered to inflation. So you're not going to lose on inflation, but you'll just lose on capital loss. Now, the other one is utilities, which of course we think is basically the crash is because the 10-year pays a better yield and technically is supposed to go down less.
Right.
The yield on the XLU is down to what, 3%?
Yeah. What is that? 3.25, 3.25.
Not as good as I would think. I remember when utilities during the financial crisis was paying 5-6%.
I remember that also.
So, but this is a crash, 78 to 82. That's more than 20%.
Yeah, that is also ugly.
And in terms of 5-year, there you go. It's like these parabolic moves have a lot to work off, don't they?
Yeah, they sure do. I mean,
utilities looks ugly. That looks like a good short. And this looks like a retest to a neckline of broken support here at around 65.
Yep. With all the factors, negative money flow, negative relative strength, negative power or bearish power gauge.
This is the aggregate bond market. So this combines government bonds, corporates, different layers of risk, but it is essentially the market that would fuel the growth of an economy, especially one that needs to reindustrialize, which is, I would say, if there's war coming, America is already kind of tapped by sharing its weapon stocks with Ukraine. And I noticed that some of the big defense contractors are talking proudly about being able to meet the Ukrainian HIMARS order by 2026.
Just in the nick of time.
What the fuck are we going to do if China starts cruise missiling us to death and we have to respond?
Yep. Kind of a precarious situation.
I just wonder if our government officials think to themselves, like, does Biden say, oh man, I'll be on the ground. I'll be underground by then. You know, I do worry about that.
Yeah.
Here's the cues. And I just want to point this out again, because I remember years ago, AA, when after we had gotten crushed by being short during the COVID rally for part of it. And as it got going, I remember both of us saying, when this corrects, oh my God, is this going to be long and painful? Well, here we are correcting. And this is just a reminder of how far of a rally from the COVID lows this was actually.
Right there. Yeah.
Yeah. And we're about 50% of the way through it. But just as a, for example, remember, wouldn't you argue that the first few months of the pandemic totally taught a generation how to use Zoom? Or go to meeting, what have you. But we call that the year of Zoom was 2020.
Sure.
Well, I happened to notice this when I dialed it up, because you think of Zoom as the bellwether for how work works now, right? There's the COVID low.
Yeah.
There's the Zoom price.
And I mean, I think that in the end, that's going to be a pretty common theme where we give it all back.
I think this is potentially a foreshadowing of NASDAQ.
Yeah, I agree. I think we're going to give it all back. It's all going to be for a 2-year party that in the end, we're going to end up in the same place that we were.
Yep, some commissions, fees, not many dividends on the Nasdaq either. So that's a concern. Now, the one that's doing better is the multinational, and this is in the face of dollar strength. It's going to probably start doing a little better, but mega caps are actually holding up more than you would think, right? And it's certainly not because of the dividend yield, which is under 2%. But overall, maybe about a 1/3 retracement from bottom from COVID low?
Yeah, just eyeballing it. That seems right.
Yeah. So bigger market cap stocks, a little bit of a dividend, more safety, although there are a few high flyers in there. But fundamental scores are kind of mixed, but not disastrously low. But Dow is starting to outperform even IWM, which had been our strong ETF going through the summer. But it's starting to, I think, accelerate to the downside. If it breaks through 160, I think we're looking at 120 pretty easily.
If you could, Mike, take that back to the 1 year look.
Yep.
The shorter term look. I think that I saw. No, I guess it wasn't IWM. I saw a pretty interesting oscillator move, but it must have been IWV, maybe. I'm not sure, but yeah, I agree. If we break that 160 level, that's going to be probably a painful move past that. Yep.
So just as an exercise, let's just take a look at the S&P 500 and see how many. Let's start with just very bullish. No other filters on this. I'm going to take filters off, and we're just going to take a look and see from a fundamental standpoint what are the absolute upper echelon of the S&P 500. So these are the strongest fundamental stocks right here. And there's maybe 1, 2, 3, 4, 5, 6, 7, 8, 9 times. This is 10 rows of 10, or rows of 9, rows of 9. So 27, maybe 35 stocks out of 50. And I'm going to view these in the workspace. So this is the best we've got here in the U.S. market based on the Chaikin indicator. We always see ADM. I'd call that flat, at best.
Seems pretty flat.
With, a little bit of relative strength, but that's just meaning it hasn't gone down as much as the market, but not a whole lot that says we're going to break out here. I guess we just recently did move from neutral to very bullish. That's certainly on my watch list. The yield is pretty low for a stock like this. Now, insurance, which is something that I kind of like, even though the relative strength has waned a little bit, seeing a lot of diagonal resistance breaks in insurance stocks. You see that?
Okay, I do.
Yeah, money flow is not great, but overall, you're going to, and I would say relative strength is starting to wane overall on the ETF, which we'll get to in a minute. Now, biotech is another one that's been waning. BIIB looks good, but that looks like an earnings driven or some kind of announcement here. I'm not sure what. But healthcare is a big theme here. Here's Cardinal Health. That one actually looks pretty good, AA. Earnings coming up on November 4th, but a little breakout of a rounded baby bottom. What would you call that thing?
Yeah, definitely a rounding bottom for sure. Yeah. At least it looks that way to me.
CF, these guys somehow used to be involved in radioactive stuff. Now it's chemicals.
Little blip of negative money flow there.
Yeah, CFG Banks, another diagonal resistance break. You're going to see that a lot. EPS beat. This is Cigna, another healthcare. Looks kind of just like Aflac and Cardinal. And Cummins, which is industrial machinery, a little bit of a break up. You're going to see that a lot on the XLI here. As a matter of fact, let me. I'll come back to this. Just wanted to show you XLI and then XAR. So XLI 50-50 on the fundamentals, had a big day on Friday. It's basically we just didn't break 85, right? It held the 85 level. And then XAR,
which is that defense, aerospace defense?
Yeah, and I wanted to show you that. I think obviously there's a huge bullish engulfing. But now, of course, it doesn't look that big when you're looking at a year's worth of decline. And again, we have a diagonal resistance over the top of this. So not as impressive when you look at it this way, as opposed to when you're just looking at this breakout below a double bottom, right? Which is what this was.
Right. And also the oscillator is overbought, which it can stay there, as we've said many times, but it does kind of limit. There's a little bit of a limit put on the potential with it being there.
So insurance has been a big part of the very bullish. The other thing we're going to see a lot of is energy, oil that pays a dividend. So refiners, ConocoPhillips, trading right up to old highs, probably will break through. That's a nice cup and handle, portending a possible $60 move to the upside. Price target 170 to 180 long term. Take a few months to get there, but that one is on my watch list.
Yep.
Earnings ahead of it, not behind it. Chevron's another one. They're a refiner. And so they make money off the crack spread. Breakout this past week. Relative strength, good. Money flow, good. And this is what I'd call this one a personality change.
Yeah. Little money flow. Yep.
Earnings coming up Friday. DGX is not Hologix, it's Quest. There's a big move. So they do lab work. And that looks pretty good. Again, earnings are behind it. So this is actually something that if we can get through this diagonal level here, I'd be interested in this.
Yep. Again, a bit of a personality change.
Yep, I agree.
Yeah.
Another healthcare. So you notice the theme here. There's a big breakout, big parabolic move, but it's only just back to sort of normal. Recent money flow, recent relative strength, overbought. Probably be a little throwback retest back to $500, and I'd say go get a put spread, right?
Yep.
Gilead, once again, getting ready to break resistance. Doesn't have the money flow here, and we have earnings coming up Thursday, so it's a big week for earnings. Global Life, more insurance. You notice it's the same themes over and over again.
Yeah,
right?
it is.
This one looks like it's doing its throwback retest, but this also has earnings are on Wednesday. But this one looks good. So there's enough of these mega cap stocks that look like they want to rally to me.
Yeah. And you're right. They seem to be in the same spaces.
Yep. They're value stocks. It's not a growth stock rally. It's going to be a dividend paying value stock rally. Yeah. Genuine parts. Nobody can afford a car anymore. Everyone's going to fix theirs up.
That was a big component back in 2008. AutoZone I remember trading that through 2008, 2009.
Yep. That playbook's coming back. HIG, you and I used to trade this one all the time as a demo account. This one and HAI. Remember that? It seemed to be every quarter we were trading that. Diagonal resistance, got some money flow, got some relative strength. We were overbought and earnings coming up. Broken record here.
Yep.
This is going to be aerospace. There's a breakout. And earnings are ahead of it, unfortunately. So it's going to be hard to get into that one. But that one looks like it's off to the races. And I'm very bullish on defense stocks. I just will wait for the technicals. But I think those could be the gift that keeps on giving for years. Yeah. If we're here to cash out. Humana Hospital, again, trying to break through resistance. Kind of the same theme. Do a few more. There's a diagonal resistance break. Got a little bit of a lower low on price. Series of higher lows and oscillators. There's enough divergences here where it's just I'm cautiously bullish about parts of the market.
I agree. I'm seeing it.
Yep. So we could go on. I'm just seeing if there's Valero. Let's just check that. There's got a trading signal and Travelers above it. So there's another refiner that's looking very good.
All with earnings, of course.
Earnings, yep.
Which, by the way, did you notice this week? I'm sure you did. The moves in XLE, OIH, XOP, all the oil-related ETFs.
I did because I'm in all of them because Cheat Sheets / Check-In / Macro Monkeys said they were the stocks to buy.
Yep.
ExxonMobil.
Yeah, XOM.
Breakout. Looks like a breakout, or we're pinned right up against it. We have to look at it, but I think energy's got a lot more room to go higher.
Do you think energy in the S&P is a big reason why we've seen the rally?
It's the only reason up until Friday, right?
Yeah.
Yep. I'm going to transition over to cheat sheets here because I think that you'll get a sense of the big picture now that we've sort of done a bottom up where we can see it's basically energy, insurers, especially health insurers, and then what would you say? Maybe a little bit of we didn't see many banks.
No.
It was mostly energy and health or insurance.
Yeah, I mean, biotech was in there too, but that's health.
So here on cheat sheets, there's two sets of data we keep. One is we like to look at our relative strength tracking. And the way to view this, I've basically thrown all sectors, indexes, and subsectors into one master spreadsheet. So that way you've got 51 ETFs and a big difference between the high and low to look at. So the relative strength trends are a little bit more easy to spot. So over on the left, you'll know whether it's a sector, subsector, or index by this little nomenclature here. And then you have the ticker symbol, the description. And then this is the average rank if you take all of these rank positions in what we call the sweet spot, where we basically identify a 3 to 6 calendar month as being where we need to see the relative strength transition to take place to believe it. When it happens out here, Double, how many times have we seen whipsaws that just don't last?
Yeah, no, it's true.
Once you get into here, you start seeing it. Like XES, for example, and you could argue this is really not a relative strength transition, and you'd probably be right, but this did represent a month or two consolidation right in here. And so whenever we see a give back that's fairly deep and substantial, but then an immediate recovery, we call that a persistent relative strength trend. So while it isn't a sector rotation, it's a save, right?
Yeah.
And money flow has been persistent and high, one of the highest money flows that we have here. I want to compare and contrast this with another ETF with big money flow that you'd think would rotate into favor, but it just hasn't. To just show you how out of favor it is, Innovative Tech, XITK. Average rank is 46 over the last 3 to 6 months. Its current rank over the last 10 days is 49. It's been very consistently predictable between 43 and 50. But all of a sudden, you got this humongous, and this has been true for a while, right? We've been noticing this money flow on Innovative Tech for a while.
That's peculiar.
Yep. So no rotation, no trend, money flow. What's driving this? Well, I have some ideas because I ran some stocks for us. Just to give you an idea that what I like to do is when I identify something like that, I want to see how concentrated it is. And it looks like it's fairly concentrated. Now, even though they haven't contributed to the money flow, Netflix, which obviously from a market cap perspective is going to be a huge part of that ETF. Netflix announced earnings that were very good. They added 2.5 million subscribers. And perhaps the most important thing, Double, is they announced that they're going to start enforcing account sharing across IP addresses and make that a no-no.
Mm-hmm.
So that's going to naturally drive an increase in subscribers. And obviously, there's no such thing as non-public information that isn't shared. And obviously, insiders have known about this for a while. It's been rotating into favor. And so I think this is a story that's more than just about the short-term subscription lift due to Stranger Things and whatever else they've got in the pipeline that's attracted a big audience. We've actually got a trend here and no money flow yet. So this, I think, might be just getting started. And here's NFLX. They've already done earnings, expensive stock, but there's the move on Friday. There's money flow, which has been kind of negative. There's relative strength versus 3 and 6 month. And then this is your move higher.
Yeah, I mean, before you zoomed in there, it looked like it was also filling a gap from the previous correction.
Here's the 5-year. Before you get too excited, it's fallen a long way, and 50% retracement probably gets it back to the 21-week moving average.
Yeah.
So again, these are all bear market trades that we're talking about. We're not talking about happy days are here again. I want to be clear about that.
Right.
Probably the most interesting besides Zoom, which I shared with you. By the way, here's the relative strength trend on Zoom. It's early, right? Zoom has just been horrible, but there is some accumulation. I don't know. Is there any news about Zoom that you're aware of? None that I am aware of. No. So here's the next one. This is probably what's driving, besides Netflix, what's driving the XITK. It's UI. So persistent relative strength, multiple timeframes of uptrend. In fact, it's the only stock like this in the entire ETF. Now, this isn't every stock in the ETF, but These scores are just worse. And then what I'll show you with the UI chart, you'll want to put this on your watch list.
What is UI? I'm not familiar.
It's Ubiquity.
Okay. I'm unfamiliar with that company.
Yeah, they do something cloud-based, but here again, diagonal resistance, there's your break. A little bit of volume. Money flows big. Relative strength, this is 3 and 6 month. And then over here we have market forecast. For those of you who are cheat sheet subscribers, there's that 95 that we like to see on the momentum line. And we have the one thing we don't have is we have a mildly bearish neutral minus long-term oscillator that's going to need to go like that in order to turn it around. But that one's looking pretty good to me.
Yeah.
Diagonal resistance break, earnings coming up though. So that's this is how I explain the why on relative strength ETFs. If we go back here, I'm going to actually do something that's a little bit more visually appealing for us. I did a little summary for us of relative strength winners and losers, so that we don't have to struggle to see this. I'm going to take us off screen here.
Okay.
And so on the left-hand side is everything that's undergone a bullish rotation. We start at the top. This is more conservative. This is stuff if you average out the rank positions between 60 and 120 days. So kind of a backward-looking indicator. This will give you the strongest sector, subsector, and index ETFs that are in cheat sheets right now. So it's what you'd expect. It's what you talked about at the beginning of this block. XLE, XOP. Oil services is missing because that was later to rotate. It'll probably get up there.
That's OIH.
No OIH yet. But you've got XES, which is the equivalent.
Okay.
XHS is healthcare services. Now, a couple of these are on their way down. Now, you're going to notice biotech makes it in both lists, and it's really easy to explain why. XBI, persistently strong for most of the summer, but about 90 days ago, in the sweet spot, it moved from 5th to 17th, from the 90-day to the 80-day look-back period, and it's gone down ever since. It's now in the 40s. So while biotech has held its average, if you look on the right-hand side, you'll see that we've had a significant bearish rotation on XBI if you go look at cheat sheets. So that's why you kind of got to, you can't look at just one and not the other, right? You have to look at the average and then also the direction.
That makes sense.
Yep. And then the significant bullish rotation. So what I'm describing as significant is it's, first of all, it's a rotation, not a clawback. Sorry about that. I got to figure out how to get back. There we go. It's on the slideshow. So the difference here is, and we'll do a couple examples. Let me do XAR because XAR looked a little unimpressive, but if I show you XAR here, it looks more impressive. I'm just going to have to find it. There it is. So the average score is 19th.
Just so you know, Mike, we're still seeing your slide.
Oh, got it. Thank you. Let me fix that. Sometimes I'm too prepared, right? Too many pockets of, here we go. All right. Desktop, Vortex of Hell. And hello. Cheat sheets. There we go.
There we go. So your XAR, I think, is what we were looking at. Yeah. Oh, now we can't hear you, Mike. There. Oh, look, you're on mute. That's what it is. You're on mute.
How about now?
Now I hear you.
All right. I must have hit that by accident. So going back to XAR, this is a little late to the party here, but if you look at XAR, bullish rotation, it's just happened. I mean, it happened kind of this is the furthest back we can go, but a 26 to 16 move that has since moved to 4th in relative strength. So right direction. Don't have the trend yet. Don't have money.
Oh, you hit mute again.
Hello, hello.
Now you're back.
I don't know why I'm not touching that. I wonder why it's doing that.
Yeah, it's never been a problem before.
Yeah, that's crazy. Well,
oh, and it did it again. Did it again.
I don't know what's driving that. Let me try doing this. I will let me leave and come back.
Okay. Technology is great until it isn't.
And we're back.
And we're back. I'm wondering if you, I think you have two different audio devices. I wonder if they're fighting for control and like auto muting or something.
Maybe. Let's try that. Yeah, something's going crazy. It seems like maybe it's telling us our broadcast is over.
Oh,
the broadcast is over.
That's unfortunate.
Yeah, I mean, you can hear me now, but it's going to go mute again, right?
Yeah, I can't hear you now.
All right, and so far it's behaving.
Yep.
All right, let me try. So what we'll do is say, let's do a quick wrap up in case my mic goes dead again. If you'd like to see more relative strength charts like I just shared with you to get yourself ready for the trading week, you can go to stockcheatsheets.substack.com. If you're interested in learning more about Chaikin Analytics, AA and I actually don't sell that one anymore. We're still big fans, and we endorse it in exchange for free access, and we're glad to do that because we love it. But you can go to the website chaikinanalytics.com to learn more about cost and subscription details there. And then finally, for Macro Monkeys.
Yeah, get it wherever you get your podcast. And if you do subscribe to Macro Monkeys, do us a favor and like and subscribe and give it a little review. We'd appreciate that.
So while we're here, you kind of got an idea through XAR that when we have a substantial transition during the sweet spot and it stays, that's the important thing. It's got to hang in there, even through the short-term time frame. When we do that, this is what makes the cut AA. It's basic materials, metal and mining, aerospace and defense, and oil services. So it's all about geopolitical conflict, essentially.
Yep.
On the bearish side, XBI is cooling off. Healthcare related ETFs, especially equipment and services, consumer discretionary, and capital markets. And then up above,
capital markets being investment bankers, brokers.
Yep. And then up above is basically the top worst averages during the sweet spot. So China, real estate, treasuries, REITs, Asia ex Japan, which is heavily weighted, China, innovative tech, which we talked about, despite its strong money flow, and emerging markets.
Yep.
So I think that's a pretty good format for relative strength. It kind of cuts to the bottom line.
I really enjoy the visual you've created here. It does it boils it down and makes it really really easily consumable.
Yep. So we'll try to do that again. And since so far I'm not being removed out, I will take us over to trading signals.
Okay.
All right. You'll see the big vortex of death.
And there we go.
All right. And can you still hear me?
I can.
All right. Amazing, huh? So we'll go take a look at, oh, you know what? Let me do, did I do relative strength of commodities already? I don't think I did. Did I?
I don't think you did.
Steel is number one?
No, you did not.
Yeah, I think we want to see that because that one's interesting. So let me do that first. So again, relative strength analysis. Again, I always like to start with the money flow, and then I check for rotation, because money flow tells you whether institutions are on board and trading with you.
Yep. And what do we got? Oh, you went mute again, Mike.
Why it's happening? I'm wondering if I do something different. Let me try one other thing.
Okay.
What I'm going to do is I'm going to turn off our screen here.
Okay.
Here. And what I'm going to do is try to add that to the stream. So I'm going to go over here to present, and I'm going to see if I can grab Google spreadsheet and see if that'll allow me to. I don't think it's going to. No, unfortunately, I don't think so. Nope, that's not going to work.
As we used to say when I used to do IT support, did you reboot?
Yeah. Well, we'll spare everybody. Maybe what I could do is, if you can't hear me, AA, maybe you can walk people through. What I'm going to do is show money flow, and I'm going to show the significant transitions in commodities, and then I'll work over to the trading signals, and you should be able to do play-by-play since you know this stuff backwards and forwards.
Okay.
Okay, and I'll try to
do my best.
it. But if I go silent, we won't try to fix it.
Okay. And I'm on a small laptop, so forgive me getting close to the camera here so I can see everything. Oh yeah, you went on silent again. I'm not seeing a screen, but I will just remind people that they can just see this on their own if they'd like it. Cheatsheets.substack.com. A lot of it is provided for free, and some for premium subscribers, which is a very minimal cost. I think $5 a month is what Mike is priced at for the complete suite. There we go. Seeing something here.
Not going to last.
And he's back. Yep. Already gone there. What is that? Thank you. Oh, that's steel. It's a steel ETF. A little transition happening there, kind of getting into the sweet spot that you talked about. And both trends are up. And some money flow, 0.13. That's some pretty decent money flow going into that steel ETF. And then also money flow in those. I'm unfamiliar with those tickers, Mike. I'm less of a commodities guy. UGA, so that is what is UGA? I'll have to look that up. Sorry. Gasoline. That's gasoline. That's right. Also looking. Oh, and grain. Oh, thank you. Thank you for that. So grain DBB is base metals. Also with some money flow. I think that's what we're going for. Yep, all those have money flow. And BNO also with a little money flow. UGA. Quite a few tickers with money flow coming back in the commodity space. I think that's the takeaway here. DBE, which is oil, gas, heating oil, distillates, I'm guessing. And then the most liquid ETFs. Yeah, the story is energy, right? We talked about that throughout the course of this call. XLE, XOP. Now we see OIH. Energy is the story. And then we'll drill down to the subsectors and look at the tailwind score. Got 3 there. UUP, of course, is the dollar with a 67. XLE we've talked about. XOP we've also talked about. A buy the dip signal on UUP, which we noted earlier that the dollar has pulled back and throughout the course of the month has been flat-ish, but a buy the dip signal. Market sentiment is rising. Yeah, nothing really going on down there in those. This is a difficult exercise.
And I was just noticing that some of that looks out of date to me, Double A.
Oh, okay. Okay.
Here, I think we've covered a lot of stuff.
That was a difficult exercise, Mike. I must admit.
It's good to practice.
Yeah,
it's good to practice. All right, Double A. Well, I will send you a copy of this recording, and I'm going to get out a premium subscriber cheat sheet before I wrap up my trading day. But I've got a bunch of stuff I'm going to unload on bullishly, but it's all in the energy / a few of the.
Oh, and then you're gone. I don't know if you can still hear me, Mike, but you have disappeared.
I got to get my negative deltas down.
Got it. Yep. Get a little more delta neutral. Is that your plan?
That's my plan.
All right.
All right. I wonder if some hackers figure out how to turn my mic on and off because we are now live. It could be. All right, Double. We'll talk to you again soon.
We'll talk to you soon.